Hey there traders, I'm Lance Beggs from YourTradingCoach.com. Welcome back to our series on price bar reversals. Today we're talking about the closing price reversal pattern. If you've watched the previous video for the open-close reversal, this one will be a piece of cake. I'll show you what I mean. Actually, if you haven't seen that video, check it out first, the open-close reversal. Okay, like the open-close reversal, the closing price reversal pattern can exist at either a top or a bottom reversal, so we'll start by examining the top reversal. You'll recall this is the definition of the open-close reversal that we discussed in the previous video at the top of an uptrend. It has a higher high when compared with the previous price bar. It has a higher low. It has a higher close. And it opens near the high and closes near the low. There is one slight variation in this pattern that makes it a closing price reversal. To visualize, simply grab the closing price and drag it down below the previous closing price. Let's have a look at what I mean. So this is what it looks like. The closing price reversal still has a higher high. It has a higher low. It still opens near the high and closes near the low. But the one difference, highlighted on the left in red and shown here on the price bar, is that it has a close that managed to close below the previous close. A lower close. Confirmation of the pattern will be price trading below the low of the pattern at this point here. As usual, adjust that as you see fit for your own requirements. If you require a little more confirmation, for example, you might prefer to wait for a close below the low. And the stop loss is ideally positioned where price should not go if the setup is to remain valid, which is above the high of the pattern. Let's consider the psychology of the pattern. Obviously, being a reversal at a market top, the pattern displays bearish sentiment, but let's see how this works. Just as with the open-close reversal, everything is fine with the world as price trends upwards. That bullish sentiment initially appears to be continuing when the next price bar opens up higher. However, at this point we have sentiment changing. Something has occurred to shift the balance of power from the bulls to the bears. Supply has overcome demand and driven price back down from where it opened near the high to the point where not only does it close near the lows, but it also closes at a lower price than it did in the preceding bar. A definitive short-term victory for the bears. In this respect, that you can see that a closing price reversal at a market top is more bearish than an open close reversal due to its ability to push price even further down to close lower than the previous close. Astute traders will see this potential bearish change and may tighten stops up below the price bar at this point here if they're already long, or prepare to go short if that's their strategy. Confirmation through price trading below the price bar will see a further increase in sell orders, confirming the change of sentiment and a potential end of the uptrend here, and commencement of either a downtrend or a sideways trend move. And looking now at the downtrend and bottom reversal, they work the same, just reversed. Price trends down to the closing price reversal pattern. And that drop has brought it, if that drop has brought it down to an area of support, it's even better. Okay, but the closing price reversal at a market bottom has a lower low, a lower high. It has price opening near the low and closing near the high. But the difference in this case is that the closing price manages to come up and close higher than the previous close. Confirmation in this case is price trading above the high here with a stop loss placed below the low at this point here. And the psychology is the same as the market top, once again reversed though. Bearish downtrending sentiment appears to be continuing at the open of the price bar. But then intra-price bar we see evidence of increased demand driving price up from its opening near the low to close not only near the high but also above the previous close. A definitive short-term victory for the bulls. This therefore means that the closing price reversal at a market bottom is more bullish than the open close reversal due to its ability to rally price higher and close higher than the previous close. If price then continues higher on the next price bar, exceeding the high of the closing price reversal at this point here, this will potentially lead to a further increase in buy orders and a possible ending of the downtrend and a change to either a sideways or uptrending market. Let's see some examples. Here's Halliburton on a daily chart, trending sideways with an upper resistance in this area here just below the $23 mark, and a lower support down around the $20 mark at this point here. Price rises on an intra-range swing at this point here, so it's uptrending on the smaller time frame to test the upper resistance. It actually breaks through on this blue price bar here just above the arrow. The breakout traders have entered long, leading to a gap up on the next open to this point here, the red price bar. However, demand is not able to overcome supply in this area, pushing price back down at the close, creating a closing price reversal. So that's the red price bar right here at the arrow. The breakout traders bailing out of their losing position help to propel price lower, and the closing price reversal is confirmed, leading to a nice move down to retest the lower channel boundary. Let's look at a losing example for something different. Halliburton again, price trending down as part of the recent bear market declines of late 2008. We have a closing price reversal here. Lower low, lower high, price opening in the vicinity of the low and closing in the vicinity of the high, with price closing above the previous close. So the blue candle close here is above the red candle close at that point there. The pattern is confirmed when price trades above the high. However, we can see here in this example that the pattern did not change the trend from down to up, but instead preceded a pause in the trend for a week and a half before resuming the trend downwards. Depending on how you manage this trade, there may have been an opportunity for you to get out with a small profit or a small loss or break even, or you may have taken the full loss if you waited for the break below the pattern low at the initial positioning of the stop loss down here, which occurred on this price bar here. Lessons from this. I've mentioned a few times already in the videos, but it's an important point. Calling all of these patterns reversals is not necessarily the best representation of reality. Short-term reversal patterns, whether defined by candlesticks or price bars, do not guarantee a reversal. They indicate a change of sentiment in the short term. This short-term change of sentiment may lead to a permanent change and a change of trend. It may lead to a pausing of the initial trend, showing as a sideways move as displayed here, before then either resuming the original trend or changing the trend. Or it may fail almost immediately. There's never guarantees in trading, so place your most focus on the risk, not on the potential reward. Personally, the influence of these short-term patterns should not be expected to persist more than a few price bars, so manage it carefully in cases such as this where you're trading against a longer-term opposite sentiment, at least until you see evidence for change in that longer-term trend. In the case shown here, you're fighting one of the most bearish markets we've ever seen, with no real evidence of support at this level apart from the closing price reversal pattern. Although a valid pattern, if you choose to trade it, then you should do so with an expectation of it being a lower probability trade. Perhaps it may be better in these sort of bearish market conditions to be trying to identify a bearish reversal at the top of a counter-trend rally. At least that places the odds of success slightly more in your favour. So always consider the context of the market you're trading within. Okay, so coming up in the next video, we're going to look at the hook reversal, and then we'll follow that up with a number of other short-term price reversals, the key, island and pivot point reversals. I look forward to speaking with you again soon. I'm Lance Beggs from www.yourtradingcoach.com, wishing you, as always, many profitable closing price reversal patterns.